Welcome to FinTech Central. This is Byte-Sized Intel, where we break down complex tech and finance topics into simple, no-fluff explanations, all in under 3 minutes. Let's get into it. So, what is the Bitcoin halving? Think of Bitcoin like a game with built-in scarcity. Every time a new block of Bitcoin transactions is added to the network, the person, or rather the computer, that adds the new block, gets rewarded with newly created Bitcoin. These computers are called miners. They solve complex puzzles to verify transactions, and when they succeed, they earn Bitcoin as a reward. But here's the twist. Roughly every 4 years, that reward gets cut in half. That event is called the Bitcoin halving. Let's simplify it even more. Imagine splitting a chocolate bar with your friend every few minutes. At first, you each get a big chunk, but every so often, the bar gets sliced thinner, half the reward, same effort. That's what happens to Bitcoin miners. Think of a block like a page in Bitcoin's public ledger. Every 10 minutes, a new page gets filled with recent transactions. When Bitcoin launched, miners earned 50 BTC per block, then 25, then 12.5, then 6.25. After the most recent halving in April 2024, it dropped again to 3.125 BTC. And the next one? It's already on the clock for 2028. Why does this matter? Because it slows down the creation of new Bitcoin. Less new supply hitting the market, while demand stays the same or goes up. That's why some people believe halvings push prices higher. And historically, that theory has played out. The biggest Bitcoin bull runs have often kicked off after a halving. Not instantly, but in the months that follow as supply tightens and investor interest builds. A quick side note, a bull run is when prices surge and stay high for a while, driven by hype, demand, or market cycles. Here's the bigger picture. There will only ever be 21 million Bitcoin. That's hard-coded, and the halving is how we get there, slowly, predictably, and with less inflation over time. Each halving makes new Bitcoin harder to earn, and that's what makes existing coins feel more scarce and more valuable. So why does it spark so much hype? Because it reinforces scarcity. It's a reminder that Bitcoin is limited, and every halving makes it harder to come by. For long-term investors, that's a big deal. But let's be clear, halvings don't guarantee price spikes. They just change the supply side of the equation. The rest? That's driven by demand, investor sentiment, regulation, and macro trends. And just to be extra clear, the halving doesn't change what Bitcoin does. It just controls how fast it's released into the world. So, what have we learned? Bitcoin halving equals miner rewards get cut in half. Fewer coins enter circulation. Scarcity increases. And historically, that's been rocket fuel for bull markets. But don't just chase the hype, understand the mechanics. This has been Byte-Sized Intel. If you found this helpful, hit like and subscribe. And check out the rest of the series for more sharp, simple explainers. Right here on FinTech Central.